It's 4,047 in the morning in Geneva. A UN hydrologist is staring at a chart she's checked 3 times because the numbers don't make sense, except they do. They're just terrifying. In January 2026, the United Nations did something it's never done before. It declared the world officially bankrupt, not financially, hydrologically. Global water bankruptcy. That's the official term now, and it changes everything, especially if you're thinking about where to put your money over the next 2 decades. Here's a number that'll reshape how you think about your portfolio: $58 trillion. That's the annual economic value of water, 60% of global GDP. And according to the UN's new report, we've been withdrawing from that account faster than nature can replenish it. We're overdrawn. Permanently. Today, we're breaking down what water bankruptcy actually means, and more importantly, where the smart money is flowing as the world scrambles to respond. First, let's get something clear. Water bankruptcy isn't the same as water scarcity. It's worse. Much worse. Scarcity means you're running low. Bankruptcy means recovery is impossible. The UN defines it precisely: persistent overwithdrawal from surface and groundwater relative to renewable inflows, resulting in irreversible loss of water-related natural capital. In plain language, in many regions, the aquifers and rivers that sustain civilization for millennia will never ever return to historical levels. This isn't a distant prediction. 3 billion people right now live in areas where total water storage is declining. And here's the kicker that affects your grocery bill. Over 50% of global food production happens in those same water-stressed regions. Half the world's food, grown where the water's running out. For decades, we treated groundwater like a savings account, something to tap when rainfall fell short. Turns out we've been treating it like a credit card with no limit. And now the bill is coming due. Not in some abstract future, but in concrete economic terms that markets are only beginning to price in. By 2050, roughly 46% of global GDP could come from areas facing high water risk. That's up from just 10% today. A 5-fold increase in economic exposure. The annual cost of drought alone, not all water issues, just drought, hits $307 billion globally. That's roughly the GDP of Ireland. Every single year. Now, here's where it gets interesting for anyone thinking about where to allocate capital. Markets are, and I want to be careful how I phrase this, systematically mispricing this risk. As Fortune reported in April, markets are not pricing in water and drought risk. The financial world hasn't caught up to the physical reality. This disconnect between existential resource constraints and relatively small portfolio allocations represents either a massive blind spot or an emerging opportunity. Possibly both. Here's what the investment gap looks like. The World Economic Forum estimates we need $13.2 trillion in water infrastructure investment by 2040. That's trillion with a T. Currently, only 2 to 3% of global water infrastructure investment comes from the private sector. The rest is government spending struggling to keep pace. That gap between what's needed and what's being invested is precisely where opportunity tends to emerge. The question is how to think about positioning. Let me walk you through a few approaches, and I want to be really clear here. This isn't advice on what you should buy. Your situation is specific to you, but the frameworks are worth understanding. For diversified exposure, water-focused ETFs have emerged as one vehicle. The Invesco Water Resources ETF, ticker PHO, carries an expense ratio of 0.59% and holds companies like Xylem and American Water Works. Investors looking at this space might consider water-focused ETFs like PHO, CGW, or FIW for exposure to utilities and infrastructure companies without betting on individual names. There's also the targeted approach. American Water Works, ticker AWK, is the largest publicly traded water utility in the United States. Veolia and Xylem handle treatment and infrastructure globally. But here's something most water investment discussions miss entirely. The biggest exposure might already be in your portfolio, hidden in sectors you don't associate with water at all. Semiconductor manufacturing, massive water consumer. Data centers? They don't just need electricity, they need cooling. Agriculture-dependent food companies? Their entire supply chain runs on aquifers. Goldman Sachs' analysis suggests that evaluating holdings through a water risk lens has become increasingly relevant. Companies in stressed regions face long-term operational headwinds that quarterly earnings don't capture. It may be worth reviewing your existing holdings, particularly in agriculture, semiconductors, and real estate, for water risk exposure in their operating regions. Real estate investors face a particularly tricky calculation. Some Sunbelt markets that seemed like sure bets 2 decades ago are now wrestling with fundamental supply constraints. Center pivot irrigation technology, those massive circular crop patterns you see from airplanes, can boost water efficiency by up to 95%. That's where agriculture technology investment is flowing. The UN Water Conference, scheduled for December 2026, only the second such conference in UN history, will likely catalyze policy changes that create both winners and losers. Countries are already implementing water protectionism, restricting exports of water-intensive crops, limiting foreign investment in aquifer-dependent industries. This could strand certain agricultural positions. AllianceBernstein's research on water scarcity notes that sustainable investors are increasingly treating water availability as a core component of due diligence, not an ESG afterthought. Now, I should mention, some analysts argue this is all already priced in. That thematic water investing is more marketing than genuine alpha generation. And there's fair criticism of the private investment solves everything narrative. Water infrastructure has historically been a public responsibility, and many argue it should remain so. These are legitimate debates. The point isn't to declare water investing the next big thing, it's to ensure you're at least incorporating this variable into how you think about long-term positioning. If you're holding agricultural companies heavily dependent on aquifers showing depletion, it may be worth understanding that exposure, regardless of how you ultimately decide to act on it. Here's a framework you might consider: map your current holdings against water stress regions. MSCI and S&P both publish tools that help identify geographic water exposure. For utilities exposure, look beyond pure-play water companies to diversified infrastructure holders where water represents a growing share of the portfolio, reducing single thesis concentration. Consider treating this as a decade-plus secular theme rather than a trade. Infrastructure build-out moves slowly. The returns, historically, have tended to be steady rather than spectacular. The infrastructure timeline extends to 2040 for the initial build-out, with the UN Water Action Decade concluding in 2028 and SDG 6 Clean Water and Sanitation facing its 2030 deadline. I want to circle back to something important. Your risk tolerance, your timeline, your tax situation. All of these change the math on any investment thesis. What works for a 30-year-old accumulating wealth looks very different from what makes sense for someone approaching retirement. The frameworks are universal, the applications aren't. Whatever you decide, the key takeaway is this: water has moved from environmental concern to financial variable. It deserves a place in your analytical framework, even if it doesn't change your current positions. The UN report uses a phrase that stuck with me. They call water investment a practical platform for cooperation. It's rare for infrastructure to carry geopolitical implications this direct. Water bankruptcy isn't coming. It's here. The only question for investors is whether to incorporate this new reality into their thinking or continue as if it's someone else's problem. If you found this analysis useful and you want to keep up with these kinds of structural shifts, hit subscribe. We cover stories like this every week, breaking down what the numbers actually mean for your money. Because here's what I've learned covering markets for years: the stories everyone's talking about are already priced in. It's the slow-moving structural shifts that create the real opportunities. Water's $58 trillion economic value isn't theoretical. It's flowing through every sector of the global economy: agriculture, energy, manufacturing, technology. It's just been invisible in most investment analysis. That's changing. And when conventional analysis starts incorporating unconventional variables, that's usually when the pricing inefficiencies start to close. So, Global water bankruptcy. Not a headline designed to scare you, though it probably should concern you. An economic reality that's reshaping how serious money thinks about the next 2 decades. $13 trillion in needed infrastructure. 46% of global GDP at risk by 2050. A pricing inefficiency that serious analysts are only now beginning to address. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. Past performance doesn't guarantee future results, but the patterns are worth understanding, and your job isn't to bet on any single outcome, it's to position for multiple scenarios with your eyes wide open. That's Money Moves Daily. See you next time. Remember, this content is for informational purposes only and is not financial advice.